the topic of adding value to commercial real estate is something that's really dear to my heart. And so hopefully through this presentation, you guys gain some value. We'll talk about some strategies in order to help you maximize the value you receive from these commercial investments. And so to start off, I wanted to share a quote about commercial real estate that's kind of applicable to what I just mentioned, is that commercial real estate is really a black box. It's super opaque and it's hard to get the information. Like I said, there is a lot of information out there about commercial real estate, but a lot of times I feel like it's not very straightforward and they try to make it confusing intentionally, which really doesn't make any sense to me. So I tried, hopefully through these talks and these videos, you are able to gain the value that you need to in order to make sure that if you do decide to invest in commercial real estate, you do so with the right tools. And so that's what the goal of this particular presentation will be. All right, so now in order to determine how to add value to commercial property, you have to first understand how commercial property is valued. Unlike residential real estate, on the residential end, generally speaking, they are valued based on a comparable approach. What is a comparable approach? Essentially what it means is that if a property is located in a neighborhood and it's a 3-2, meaning 3 bedrooms, 2 bath building, and it sells for 200 grand, if you own a similar property in that neighborhood that's 3 bedroom, 2 bath, you're not gonna be able to sell that property for much more than that 200 grand. Even if you do go above and beyond and have nice granite countertops in there, you replace all the exterior, make it look beautiful, you have an in-ground pool, whatever else, you're not really gonna be able to push the value of that property much more than the 200 grand value. Unlike commercial real estate, where especially income producing commercial real estate is going to be valued based on the income approach. The income approach is essentially how much does the property produce? How much income does a property produce? And the equation that we use to determine the value of a commercial property is listed right here, which is value is equal to net operating income and cap rate, divided by cap rate. So let's unpack each of those terms so you guys have an understanding of what that means. The net operating income is the income left over after accounting for all your operating expenses. So this includes your maintenance of the property. This includes any utility bills that you have to utilize. I mean, it accounts for everything related to making sure that property operates as intended. Now, the cap rate, on the other hand, is the expected return of the property if the property had no debt on it. So, for example, if you were going to buy a commercial property for $1 million and the net operating income for the property was $70,000, the cap rate for the property would be 7%. So what that translates to is that you would put $1 million into the building and you would expect a 7% return on your money having made that investment. And you can kind of see how the value would be portrayed here in this particular example. If the property has $54,000 of net operating income, you can divide it by a 6% cap rate if that's the cap rate that those assets are trading at, and you get a $900,000 value for the building. So that's kind of a high level view of how commercial properties are valued. Now, generally speaking, cap rates are dictated by the market. So when the economy is doing well, cap rates compress, meaning they get smaller because there's more money in the market. There's more investors in the market that are looking for deals, and that drives the cap rates lower. Now, in the case where you're in a market downturn and banks are hesitant to loan money, then there's less transactions happening, therefore cap rates expand. So really, it's harder for you to impact the cap rate property versus the net operating income. So in this particular presentation, we're going to focus on trying to maximize the value received from the net operating income. And there's 2 ways to modify this value. The first way is to increase revenue for the building, and the second is to decrease expenses. So throughout this presentation, we'll focus on providing a few strategies for each of these particular talking points. Make sense? Okay. We'll go ahead and. All right. So the first section, we'll focus on increasing revenue. Now, the first strategy that you can use to increase revenue is probably the most self-explanatory, is to increase occupancy. And this applies to all property types. So generally speaking, if you're an if you're an opportunistic investor, you're generally going to buy properties that have some either operational deficiencies or they're not being filled correctly, right? There's just not enough tenancy within the building. So in the case where you buy a property that is struggling from an occupancy standpoint, there are a few things you can do to bring up the occupancy. First, if the property itself is in disrepair, that would require you to renovate the space to bring it up to standards for what the market dictates. And therefore, you can probably start getting more people into the building and more interest in renting out space within that building. And that applies to both multifamily, retail, industrial, whatever. That's probably the most cost-heavy approach. Maybe in the case where you don't necessarily need to invest as much money in the building, there are other strategies you can use in order to maximize the amount of people that are renting in that space. So these are some of the rental strategies. Now, I will share this one particular rental strategy because I can't tell you how many times I've seen landlords that kind of are like, oh, I have to rent it out for this market rent in order to maximize the value of the building. However, what they don't realize is that if you price something slightly below market rent, you're going to have more interest from parties, in particular if they perceive it as being of value. So in the case, I have a fourplex that I own. I have a small multifamily that I'm living in, house hacking, and I always price the units slightly below market because it generates a little bit more interest from a lot more tenants. Therefore, I have a better pick of tenants, and I can pretty much pick and choose who I want. And my goal is to hold this property for a long period of time. So I'm not really super concerned with making sure I maximize the rents right off the bat. So if your strategy is to hold the property for a long period of time, maybe it's best to just advertise them for slightly below market rent and then try to fill the property that way. Number two is rental concessions. This is very common in pretty much all types of properties. By rental concessions, that means maybe offering free rent, maybe offering reduced rent for a period of time, or maybe offering some other sorts of concessions like what's known as tenant improvement allowance, where you allocate a certain amount of money to the tenant in order to fix up the space for their use. Those are definitely different strategies that you can utilize in order to fill the space. And then finally, are referral fees. This is one that I really like using because if you have a tenant that is a good tenant, if they have friends and other business owners that are similar, they may be phenomenal tenants as well. So if you can offer your existing tenants and say, hey, look, we have a vacancy in this particular space. If you know of anyone who's looking for a space that you can vouch for, I'd be happy to provide you with a referral fee. That can be also another way for you to increase the occupancy of the property. Okay. All right, so number two, this is also something I've seen people do, is they have vending machines. This is particularly common in high foot traffic locations where there's a lot of people walking around and such. On average, the average American spends about $62 per year on vending machine purchases. In this case, if you have, let's say, a small retail shopping center and you can have, there's a lot of foot traffic in that area, you may be able to put a vending machine outside, or if you have an office where you just put a vending machine where people go on a regular basis, maybe they have their businesses there, that could be a good way for you to generate additional income. Now, in this strategy, you just want to make sure you perform the analysis. Generally speaking, purchasing vending machines can be a decent capital investment. You can also rent these vending machines, but you just have to make sure that the cost benefit analysis makes sense. You also have to take into consideration that this is a business. It's not necessarily just a passive thing. You're going to have to regularly fill these vending machines. If there's any issues with the vending machines, you're going to have to get someone to repair them. So it is very much a business that you're going to be operating, but it can be a good way for you to generate additional income from the property. And I've included some links in this PowerPoint. So if you guys do want the PowerPoint shared with you, feel free to reach out. I'll be happy to share it with you all. So number two strategy is to consider utilizing vending machines on site, in particular if your building has high foot traffic. All right, so number three, this is very common in particular with multifamily properties, is if the units themselves do not have washer dryer hookups, consider providing coin-operated laundry on site. The average family does 8 to 10 loads a week. Generally speaking, if they have to pay for the loads themselves, they may compress the amount of loads they do and try to make do with maybe a few loads a week. But still, I mean, you're going to be able to generate additional revenue from the property utilizing the strategy. And there's both coin-operated laundries, and now with technology the way it is, you can have the tap. With your credit card, you can just tap and they can make a payment and they'll process that way as well. So those are options as well. However, you do want to do the analysis on this. I was looking into doing it for my fourplex. However, there's just not enough. There's not enough people in the building. So I did the analysis for buying the units and also renting the units. And in both scenarios, it just didn't work out from a cost benefit perspective. So, but if you're buying maybe an 8-plex or a 12-plex or 16-plex, or in Robbie's case, he was mentioning he's looking at properties in the 40 range, that could very much be a beneficial strategy to employ, in particular if those units don't have washer dryer hookups. So number 3, as a revenue generation strategy, consider a laundry facility as an option. Now, this is one that's really interesting to me. It's related to leasing signage. This is very valuable if you are in a high traffic location with great visibility. Generally speaking, you have a sign on your site and you lease the sign itself to a business owner or some other investor for long-term contracts. And just to give you an example, we were looking at a property last year in November, I want to say, over on River Road. It was about 3-acre plot of land. There was a building on site which didn't have much utility. It was really just primarily a development plot of land. However, they did have a large sign on site. They had, I think it was 40 feet in the air. It was 20 feet wide and 10 feet tall. And it overlooked the major highway there. And it had probably about 65 or 70,000 cars a day that went by that sign. And that sign was leased by a personal injury lawyer for well over $1,000 a month. And they had a long-term contract, like 10 plus years, with various options on top of that as well. So if you think about it, if you have a piece of property that is in a high traffic location and you're able to get the signage permits to be able to do it, that could be another way for you to generate income that's 100% passive. You literally don't do anything. So, I mean, and if you structure the lease accordingly, you may be able to even say, look, if something were to happen to the sign itself, maybe the other person's responsible. How do you structure that agreement? But that's a good way for you to generate additional income, in particular if you're talking about high traffic locations with great visibility. However, before implementing the strategy, you really have to talk to your city government to determine what the regulations are for signage. Generally speaking, you're not going to be able to put up a sign anywhere you want to on your site. You're going to have to go through the city to see what the regulations are for how high your sign can be off the ground, what width the sign can be, etc. And so definitely check to see with your city to see if this is a viable strategy for what you want to do. And then finally, this is one that I think can be extremely valuable to people, in particular if you buy a property that's in a good location, but it needs some work, in particular on the exterior. Generally speaking, when you're talking about renovating the interior of a commercial property, it can be quite expensive. We actually did a webinar recently related to commercial construction, and we talked about the difference between a commercial construction project and a residential construction project. Generally speaking, commercial construction quotes are going to be very much higher than a residential quote because there's a lot more red tape. There's a lot more things that need to be taken into consideration in order to maintain the public safety, meaning that those commercial spaces are going to be utilized not just by the people who quote unquote live there. So if you were to, for example, in your house, you're primarily the only person who's going to live there and you have people come over your house occasionally. But in these commercial settings, if you're an office or restaurant or whatever else, you're going to have potentially hundreds, if not thousands of people going through your building on a yearly basis. So you got to make sure that building is going to be safe for that use. And so generally speaking, the interior renovations of commercial properties are going to be quite a little bit higher than what you would see in a residential setting. So one of the best ways to attract commercial tenants without breaking the bank of having to renovate the interior altogether is through the use of allocating funds for exterior renovation and landscaping. Just to give you an example of how this was a strategy was utilized, there's a commercial broker in Tennessee. His name's Tyler Cobble, and he's written a book on commercial real estate. And he mentioned how he was able to buy a strategically located office building near downtown Nashville. The interior was just a little bit outdated. They were having trouble with occupancy, but really where the value of the building is trying to update the exterior. So what they did is they went in there, they repainted the exterior, they modified some of the exterior to make it more attractive. They planted shrubs, they planted bushes, they redid the parking lot to make it look inviting. And that itself started attracting more tenants as potential participants for that particular building. And in interior, they didn't allocate a whole bunch of funds in the interior. They just wanted to bring it a little bit up to date. So for the kitchenette, they updated the granite countertops or whatever else. But overall, the bulk of the investment was in the exterior. And that itself started bringing more tenants to the location because, number one, it was strategically located, and two, it was attractive from an exterior standpoint. So generally speaking, if you're going to purchase a building that's well located that needs some exterior work, that could be a good return on your ROI by just updating the exterior. Make sense? All right, so I know that's a lot of information. Like I said, this is going to be available to you guys via my, if you want to just reach out to me, and I'll be happy to provide you with some slides as well. All right, so now we've gone over the five strategies that you can utilize to increase your revenue for the commercial property. Now we're going to go into the decreasing expenses side of the equation. All right, so this is a strategy that you can utilize to decrease the expenses of your property. So installing low flow accessories, this is something that I did in my property. This has to do with installing aerators, low flow aerators, faucets, shower heads, toilets, low flow toilets. And the reason why this is very valuable is, in particular, in older buildings, they were built as a single use property. And so when they were converted to multi-tenant properties, generally speaking, the landlord is the one going to be responsible for paying the utilities on the building because they're not individually metered. So if you're responsible for paying the water for your building, you could potentially save 20 to 30% or 20 to 40% from a flow perspective, which could translate to a significant savings over a period of time, in particular if you're talking about larger properties. So if you have a 40 unit property or 50 unit property, if you even save $5 to $10 a month in water usage, if you're responsible for paying the water bill, I mean, that could translate to $500 a month over the course of a year, $6,000, so that's a sizable amount of difference, which could add a significant amount of value to your building. So if you are responsible for paying your water, consider installing low flow accessories. They're not they're not extremely expensive, and over time they can provide you with a really good ROI. All right, so this is a strategy that you can utilize, especially for older buildings. It's called submetering. Like I said before, in older properties, a lot of times they were built to be single use, meaning there was one use in that building. However, over time, they may have allocated different sections of the building for different tenants. So if, let's say, you buy an office building, there may have just all of a sudden now they decide to break it out into multiple different floors in order to lease to other tenants. In that case, there may not be individually metered, meaning that you won't know what the usage of each tenant is. In that case, what you can do is you can individually submeter each unit so that you know exactly what usage people are having on a month-to-month basis. Now, the benefit of this is it helps with monitoring. Like I said, you know exactly what each tenant is spending each month as far as their utility usage is concerned, and it helps with accurate billing. So your tenants know exactly what they're going to pay each month based on what they use. The only downside to submetering is it can be very expensive. When you do start submetering properties, the price can be quite expensive, and the ROI may not be as strong as this next strategy, which we'll talk about. All right, so number 3 is the ratio utility billing system, which is similar to what submetering is, except what you do now is you allocate the bills based on a pro rata basis. So let's say you have a couple tenants in a building. Let's say there's a small strip center and there's 4 individual tenants in each in each section, and you could allocate 25% of the bill to each tenant because there's 4 tenants in the building. Divide the bill by 4, and that's how much people pay based on the utility system. The benefit of this is it promotes conservation, meaning that people usually spend less on the utility usage when they are the ones responsible for paying for it. And yeah, that's one of the biggest reasons. And it's not as expensive from a capital investment perspective. So you don't have to invest in these very expensive submetering systems, which could be very capital intensive. What if you were to do this though? Just make sure that if you have a property manager, they're very familiar with this process, because it's going to add a lot of paperwork. It's going to add a lot of documentation, and it could be something that can be difficult to manage if they're not familiar with it. So that would be my one strategy for you, is just to make sure they're familiar with that process. All right, so number 4 is common area maintenance. This is something that's very common in multi-tenant properties, in particular, retail, office, industrial. What this means is that you essentially pass along some of the expenses to maintaining the common areas of the building to the tenants. So just imagine there's an office building, right? A common area for an office building may be the hallways, it may be the bathrooms, shared bathrooms, it could be the elevator. Anything that's used by more than one tenant is considered common areas. And you have electricity that needs to be able to, you need to be able to utilize for that space. There's water, whatever. So what you would do, similar to what we had in the R.U.B.S program, is you could bill each individual tenant on a pro rata basis for this particular usage. Now, the main issue with this is that you have to review the lease agreements when you purchase a commercial building to make sure that you're able to do this. And if you're not able to do this based on the commercial lease agreement, you have to wait until those leases expire before you can write another lease that you could utilize for that usage. So something to consider when you are looking to purchase a commercial building. Just make sure you review the leases carefully and see if that's a strategy that you can use in order to pass along those expenses to the tenants. And then finally, the last strategy I'll provide with you guys is related to renegotiating contracts. Generally speaking, when you purchase a commercial building, there will probably be pre-existing contracts for handymen, property managers, internet, whatever you can think of. And when ownership passes from one individual to another, those contracts are null and void. So what you would do is you would approach these contracts or service professionals that you had before and see if there's a way you can structure a deal that saves you money, that the previous owners, for example, wouldn't have been able to do, because they do want to retain your business. And that's the big thing, is that just go into the negotiation saying, look, we'd love to keep you on as a handyman or property manager or whatever service that this person's providing you, but we want a discount on this particular agreement that we're going to sign for you. And what I would say is just asking can really, I think, save you a significant amount of money versus just not asking at all. You really won't know until you ask. Okay. So I know that was a lot of information. Like I said, I will make these slides available to you guys. I wanted to make sure that we had enough time to be able to provide time for questions if anyone had any. So feel free to ask away if you have any questions.
We got a lot of information in how to reduce the cost. Like I don't know about that, the laundry thing, like what you explained just one. Maybe I implement that. But thank you for all this, a lot of information here.
Yeah, no, I appreciate that. And like I said, with laundry, it couldn't be a very lucrative value proposition if the numbers work out. So generally speaking, with those, you really want to make sure that you have enough scale to make it valuable. Because, for example, with my fourplex, it just didn't pencil out very well. But if I had a 30-unit property that didn't have any washer dryer hookups, it most certainly would have worked out. I probably could have put 2 to 4, I mean, two washers, 2 dryers on site and made the math work out. In which case, I mean, and that's another cool thing about commercial properties, is that even $1,000 benefit to the net operating income can translate to thousands and thousands of dollars in value for that commercial property. So, cool. So let's make sure, I want to make sure that everyone if anyone had any other questions. Okay. All right. Well, I mean, thanks again for stopping by, guys. Hey to everyone on Facebook. I will make sure to, let me just make sure I have if everybody on Facebook has any questions before I hop on. Okay, yeah, great. So what I will do is, like I said, if you guys do want any of these slides, feel free to reach out. I'm always happy to provide this information to you guys. Along with that, if you guys have any questions related to commercial real estate, feel free to reach out to me.
Sure.
Like I said, that's my email, that's my phone number. Along with that, if you guys are looking to buy, purchase, or sell or lease commercial property, feel free to reach out as well. And again, this will be posted on YouTube. So if any of you guys are currently watching on YouTube, feel free to subscribe, like the channel, and share it with whoever you think would gain some value from it.